There is another factor, of course, underpinning, I think, some of the young people looking at getting into the market now, having stood back for a very long period of time, and that is the aggressive rate discounting which is going on by the banks. Now, for your guide, this is happening in Australia as well, where banks are writing loans at losses. Well, hello again, everybody. Things are becoming a little bit interesting in some parts of the residential real estate and mortgage market at the moment. Last week, or perhaps it was 2 weeks ago, I mentioned that in my monthly survey of mortgage advisors all around New Zealand, I could see evidence that first home buyers were starting to move back into the market. And I think I ran through a list of reasons maybe as to why they were doing that. And one of the reasons was that we've had house prices fall quite a bit from the peaks in late 2021. They've gone down about 16% or so. That still leaves them 20% higher than ahead of the pandemic. But of course, wages have risen a lot over that period of time. So where we sit physically right now, the end of February, the start of March, the ratio of the average house price in New Zealand to the average wage looks like it's basically back where it was 3 years ago, just before the pandemic struck. Now, that obviously doesn't mean the level of demand for housing is going to go back to where it was then. There's basically still no FOMO, fear of missing out in the economy. And of course, interest rates are relatively high. But young buyers are likely doing a comparison with rents. And I can see from a monthly survey I do of existing residential property investors that an increasing proportion of them are looking to increase their rents. The average rental rise they are seeking has gone from about 5.3% 3 or so months ago to about 5.7, 5.8% now. No huge movements, but it's the direction of change, I think, which is quite significant in the context of house prices coming down. And of course, it's fairly obvious with the terrible destruction we've seen in parts of Northland, bits of Auckland, obviously in Gisborne, Hawke's Bay, etc. There's going to be an increased demand for rental accommodation and maybe some people relocating as well. It's sort of a no-brainer what it does, unfortunately, with regard to upward pressure on rents and on house prices there. There is another factor, of course, underpinning, I think, some of the young people looking at getting into the market now, having stood back for a very long period of time, and that is the aggressive rate discounting which is going on by the banks. Now, for your guide, this is happening in Australia as well, where banks are writing loans at losses. They are borrowing money to lend here and they are lending it out at a rate there. At the moment, there's one bank in New Zealand which is lending out 1 year fixed at 4.99%. That's the rate there. The cost to them of borrowing the money up here is about 5.5%. So definitely a loss-leading product there, and goodness knows how long they'll be able to keep that up. There's a couple of others who have 18 to 24 month rates at the likes of, I think, about 5.99%. Now, again, I don't know if these things are necessarily going to last, but what they do is reaffirm a point I have made previously, that we're in an environment now where we can see inflation is going to ease off a bit, some weakness in the economy, nothing too major necessarily, but people are taking the worst case scenarios for interest rates off the table. I see no evidence that people are strongly of the belief inflation's going to plummet, interest rates will fall away really, really quickly, they're going to be 2% lower in a year's time, or something ridiculous like that. No, it's simply, I think, that people are pulling back from believing that we're going to get another 1% or so on interest rates from where we are at the moment. And look, I see a number of other analysts out there saying they think we've seen the peaks in the fixed mortgage rates, and recall that's something I started saying about 3 months ago after the Reserve Bank did the record cash rate tightening on November 23. I said I was 90% confident we had seen the peaks for 2 year fixed rates and beyond. For 1 year, 50-50 call out there. I'm pretty happy with that commentary that I put across at the time. Let me just finish off with one other point, which I really don't think people have picked up on yet, but this is going to attract attention later on this year. 6 months ago, New Zealand had a net migration loss of people from our population of 16,000. Now we have a net annual migration gain of 16,000 people. The migration numbers have turned around relatively swiftly. We have a habit of seeing this happen in New Zealand, and the way things are going, you take us 6 to 9 months down the track from where we are now, you're looking at maybe plus 35,000, maybe even pushing plus 50,000 net population gain from migration flows. That at some point will occupy people's minds. there's the election mess later on this year, so I certainly don't for a second think we're going to see any great number of investors coming back in the market. But the first home buyers, well, I guess I'm relatively pleased. A good number do seem to be taking the opportunity provided by a high level of listings out there at the moment. The vendors more willing to negotiate on things and recognise that pretty much this is the best it might be for a generation or two in terms of being able to pick and choose amongst the properties on offer and find something most suitable for yourselves going forward. All the best out there. All the best for anybody affected by that bad weather as well. Cheers.